Good morning and welcome to the Morning Bell. I'm Robert, joined as always by Lizzie and Steve. It's Tuesday, August the 4th, 2026, and we have a packed show this morning. Equity futures are pointing firmly higher, oil has taken a sharp drop overnight, earnings season is delivering some notable numbers, and we've got key economic data hitting the tape today and through the rest of the week. Let's get straight into it. Lizzie, set the table for us. Futures up, oil down roughly 5%, earnings running hot. What's the single biggest driver of this morning's rally?
Morning, Robert. The single biggest catalyst is President Trump's decision to stand down on military action against Iran and restart diplomatic talks, which sent Brent crude tumbling over 5% to around $83.44. And that oil relief is landing right on top of what is already an exceptional earnings season, with over 83% of S&P 500 companies beating EPS estimates and blended year-over-year earnings growth running near 47%. Nasdaq futures are up about 0.8%, S&P futures up 0.6%, and the mood this morning is genuinely constructive across the board.
How durable is that oil relief trade, and does it actually move the needle on the inflation picture for equities?
The durability question is the right one to ask because geopolitical ceasefires can reverse quickly, and with the Fed already showing 3 dissents in favour of a rate hike and inflation still above target, a single week of lower crude doesn't fundamentally change the Fed's calculus, but it does remove one acute pressure point that had been complicating their already difficult balancing act, and equities are responding accordingly to that breathing room.
Morgan Stanley's Wilson is calling for S&P 8,000 by year-end and wants investors rotating out of chip stocks into quality names like insurance and healthcare equipment. Do you buy that thesis?
The rotation argument has real merit here, particularly given that Goldman's momentum basket is down 35% from its June peak. That kind of drawdown signals the narrow chip and AI momentum trade has run its course for now, and Wilson's emphasis on quality names with stable earnings, strong margins, and operational efficiency aligns well with what's actually working in this earnings cycle, where upward revisions for Q3 are broadening across 8 sectors, including finance, industrials, and utilities.
With earnings revisions broadening that widely, does this rally finally have the participation to sustain itself?
It has the best fundamental underpinning we've seen in this cycle. The Magnificent Seven are tracking 85% earnings growth, but crucially, the story is no longer just about them, with finance, industrials, and utilities all seeing positive revision momentum, and that breadth is what separates a sustainable advance from a momentum squeeze that eventually exhausts itself.
Microsoft, Amazon, and Alphabet all delivered strong cloud results, but Apple and Meta disappointed. Is the AI infrastructure spending story still clean, or are we seeing early cracks?
The hyperscaler results from Microsoft, Amazon, and Alphabet confirm that AI infrastructure spending is translating into genuine commercial returns. Cloud segment strength across all three was the real signal there. But Apple and Meta's disappointments are a reminder that not every large cap tech name is equally positioned to monetize AI, and traders should be distinguishing between companies that are infrastructure providers versus those still searching for their AI revenue model.
Palantir reports after the bell today. 85% revenue growth last quarter, but shares are down over 26% year to date. What are traders watching for in that print?
After that kind of year-to-date drawdown, traders aren't just looking for a revenue beat. They want to see whether Palantir can demonstrate that its government and commercial AI contracts are expanding, and that rising competition isn't eroding its pricing power. Because with a stock that's been under that kind of pressure, guidance matters more than the headline number.
Bristol-Myers Squibb and AstraZeneca are reportedly in talks on a $400 billion merger. How are traders positioning around that this morning?
BMY is surging on the report, which makes sense given it's the smaller party at a $133 billion market cap being approached by AstraZeneca at $264 billion, and a deal of that magnitude would rank among the largest pharmaceutical mergers ever recorded. Traders are piling into BMY as the obvious target premium play, while AZN will face scrutiny over whether taking on that kind of financial commitment at these valuations makes strategic sense given the integration risks involved.
10-year yields are holding near 4.73% and the 30-year has pushed as high as 5.25%. At what point do yields become a genuine ceiling for this equity rally?
The equity risk premium data from NYU's Damodaran is actually reassuring here. The ERP has held relatively stable at around 4.23%, even as yields have climbed, meaning the implied expected return on equities has risen alongside yields rather than collapsed. But if the 10-year pushes meaningfully above 5%, the math on equity valuation starts to get uncomfortable, particularly for growth names trading at elevated PE multiples relative to the S&P 500's current 22.82 average.
Steve, yesterday we got the ISM manufacturing PMI for July. Consensus had been looking for 54.0 against June's actual of 53.3. Walk us through that release and what else is on the economic calendar today and through the week.
That's right, Robert. The ISM Manufacturing PMI for July was released yesterday, Monday, August 3rd, with consensus expecting a reading of 54.0 against June's actual of 53.3. And that June print itself came in just below the 4.0 that had been forecast. So the market was looking for a modest step up, confirming 6 consecutive months of expansion above the 50 threshold, signaling that the industrial sector is sustaining genuine momentum rather than simply bouncing. Today, Tuesday, we actually have 3 releases to watch: trade balance, factory orders, and JOLTS job openings, all for June, with JOLTS consensus sitting at 7.45 million openings against May's prior reading of 7.594 million, so a modest cooling there would be consistent with the gradual labor market softening the Fed would actually welcome. And factory orders will give us a read on whether industrial demand held up through the middle of the quarter. Moving into the back half of the week, Wednesday brings the ADP employment report for July, where the forecast is 70,000 private sector jobs against June's actual of 98,000. That will serve as a useful preview for Friday. Thursday gives us initial jobless claims, where last week's reading came in at a very contained 197,000 against a 200,000 forecast, and consensus for this week is 201,000. Then the main event is Friday's July non-farm payrolls, where the forecast is 83,000 against June's actual of just 57,000, which badly missed the 110,000 consensus and was the softest print in quite some time. And with the Fed already showing 3 dissents in favor of a hike, that Friday number carries enormous weight for the September rate decision.
So today's JOLTS and factory orders, ADP Wednesday and claims Thursday all build the runway into what is a very consequential NFP on Friday. Lizzie, Bitcoin is struggling to rally despite falling oil, lower yields, and green equities, with BTC testing the 62,000 to 63,000 support zone. Why is crypto decoupling from that macro tailwind?
The answer is almost entirely internal to crypto markets rather than macro-driven. The cold card hardware wallet exploit has now stretched to 5 days, with losses surpassing $114 million across nearly 4,600 addresses. And when you have a security event of that scale specifically targeting self-custody infrastructure, it creates a confidence shock that no amount of favourable macro can offset in the short term, as holders move back towards centralised exchanges and sentiment turns defensive.
Willy Woo is putting recovery odds at just 20 to 40%, and Galaxy Digital is warning of a potential 4th attack wave. How badly does something like this shake confidence in self-custody as a structural concept?
It's a significant setback because self-custody is foundational to the Bitcoin value proposition for a large portion of the holder base. And when a well-regarded hardware wallet like Coldcard shows this kind of vulnerability across multiple coordinated attack waves, it forces a difficult question about whether the infrastructure supporting self-custody is mature enough for the scale of assets it's now protecting. And that uncertainty compounds the structural headwinds Bitcoin is already facing, including a record 76-day negative Coinbase premium streak that signals sustained weakness in US institutional demand, alongside ETF outflow pressure from BlackRock, Fidelity, and Grayscale.
On ETF flows, there are conflicting signals. Some reports cite major outflows, while others point to over $212 million in inflows on overlapping dates. Where does institutional demand actually stand, and what are ETH and Sol doing this morning?
The honest read is that institutional demand is fragile and directionally weakening. The 76 consecutive day negative Coinbase premium is the most telling structural signal because it reflects sustained underperformance of US institutional buying relative to offshore markets. And even if there are individual sessions with positive inflow prints, the broader trend and the ETF net asset position at $76.29 billion tells a story of capital rotating toward tokenized traditional finance perpetuals rather than spot Bitcoin. For ETH and Solana, the picture is slightly more constructive. ETH spot ETFs attracted around $27 million in weekly inflows. Ethereum is trading near $1,858 with a modest gain on the session, and Solana added 2.66%, so altcoins are showing some resilience even as BTC struggles to hold that critical support zone around $62,000 to $63,000.
That wraps up today's Morning Bell. This is not investment advice. Do your own research before making any financial decisions. And don't forget to subscribe so you never miss a morning. See you tomorrow.